Imagine a family so powerful, so rich, they basically owned a city. They funded masterpieces of art that still drop jaws today. They made popes and kings sweat, all from the comfort of their opulent Florentine palazzos. This was the Medici family, not kings by title, but emperors of influence during the Renaissance. Their secret weapon was not a sword, or an army, or even a crown. It was money, mountains of it, earned through a banking empire that changed the world. You might think banking is boring, just numbers and paperwork, but for the Medici, it was a high-stakes game of cunning, innovation, and serious risk. Their methods were so advanced, they practically invented modern finance. Get ready to pull back the velvet curtain on the 7 money secrets that built a dynasty and reshaped an era. Number 1, the power of the penny double entry bookkeeping. Picture this. You are running a business, maybe a small coffee shop. You sell a latte, you take in cash, you buy some beans, you spend cash. Simple enough. Now imagine you are running a sprawling international banking network with money flowing between Florence, London, Bruges, Rome, and Geneva. You are lending vast sums to kings and popes. You are investing in wool factories and alum mines. Money is coming in, money is going out, often in different currencies on different dates from different people. Keeping track of all that seems impossible. Before the Medici, most businesses used a simpler, single entry system. It was like keeping a running tally in a notebook, money in, money out. This method made it hard to see the full picture. It was difficult to spot errors, track profits accurately for specific ventures, or truly understand the health of the entire enterprise. It was easy for things to get lost, for fraud to go unnoticed, or for a branch to mismanage its funds without anyone realizing until it was too late. The books might tell you how much money came in, but not necessarily where it went, or what obligations the business had, or what it actually owned. The Medici Bank revolutionized this chaotic financial landscape with something truly groundbreaking: double-entry bookkeeping. This was not some dusty, obscure accounting trick. It was a revolutionary way of looking at money, a system that provided an unprecedented level of clarity and control. Every single transaction, no matter how small, was recorded in 2 places, in 2 different accounts. If money came into the bank, it was listed as a debit in the cash account, showing that the bank had received it. At the same time, it was listed as a credit in another account, perhaps a client's deposit account, showing where that money came from or what obligation it represented. If the bank paid out money, it was a credit from the cash account and a debit to the account of whoever received it. The key was that for every debit, there was an equal and opposite credit. The books always had to balance. This fundamental principle provided an immediate self-checking mechanism. If the totals did not match, it meant an error had occurred, and the meticulous clerks had to find it. This system was more than just a way to record transactions. It provided a detailed, dynamic snapshot of the entire bank's financial position at any given moment. The Medici could see exactly how much cash they held, how much was owed to them by various debtors, how much they owed to their own depositors, and what the value of their investments in wool or silk was. They maintained separate ledgers for different types of accounts. Cash accounts, accounts for specific clients, accounts for loans, accounts for investments, and accounts for expenses and revenues. Each ledger was a window into a specific aspect of the bank's operations. The general ledger, like a master key, pulled all these individual pieces together, providing a grand overview of the bank's assets, liabilities, and capital. Consider a large loan made to a powerful individual. The amount of the loan would be entered as a debit in the account of that particular borrower. Simultaneously, it would be entered as a credit in the bank's cash account, showing the outflow of funds. Later, when the interest payment arrived, that amount would be debited to the cash account and credited to an interest income account. This meticulous tracking allowed the Medici to calculate profits and losses with incredible accuracy, not just for the entire bank, but for specific ventures or even for individual branches. They could tell which investments were yielding the best returns and which clients were the most reliable. The implementation of this system was a monumental undertaking. The Medici employed a dedicated staff of highly skilled clerks, scribes, and accountants. These individuals were trained in the intricacies of double entry. They worked tirelessly, meticulously entering every transaction into large bound ledgers. These ledgers were often kept under lock and key, their contents guarded closely, as they held the very essence of the Medici's wealth and power. The records were updated daily, sometimes hourly, ensuring that the information was always current. This dedication to precise record-keeping meant that the Medici family, sitting in their main office in Florence, had an unprecedented level of control over their far-flung empire. They could request financial reports from their branches in Bruges or London and receive a clear, consistent picture of their operations. The numbers did not lie, and the system ensured accountability. The Medici Bank's commitment to double-entry bookkeeping set a new standard for financial management in Europe. It was a system that provided clarity where there had been confusion, precision where there had been approximation. It gave them a deeper understanding of their own financial health, allowing them to make informed decisions about lending, investment, and expansion. They could assess risks more effectively, identify profitable opportunities more quickly, and manage their resources with unparalleled efficiency. The system became a bedrock of their financial dominance, a silent, powerful engine driving their empire forward, one perfectly balanced transaction at a time. The world would eventually adopt this Florentine innovation, but the Medici perfected it and used it to propel themselves to unimaginable heights. Number 2, the invisible handbills of exchange and avoiding usury. In the medieval and Renaissance periods, the church held immense power, not just over spiritual matters, but over daily life and commerce. One of its firmest pronouncements was against usury. Usury meant charging interest on loans, and the church declared it a sin. This created a huge problem for anyone wanting to engage in large-scale commerce or banking. How could you lend money and make a profit if you could not charge for the use of that money? Directly asking for interest was a sure path to excommunication and social disgrace. Yet, trade needed financing. The kings needed money for wars, merchants needed capital for voyages, and the church itself often needed loans to fund its own vast operations. The Medici, like other shrewd Florentine bankers, found a clever workaround that navigated this treacherous religious landscape. They did not charge explicit interest. Instead, they used an ingenious financial instrument called the bill of exchange, or lettera di cambio. This was not just a clever trick, it was a fundamental innovation that facilitated international trade and allowed capital to flow across borders without violating the letter of church law. A bill of exchange was, at its simplest, a written order to pay a specific sum of money to a specified person at a specified future date in a different currency and a different city. Imagine a merchant in Florence wanted to buy wool from England. He would go to the Medici Bank in Florence and deposit a sum of Florentine florins. In return, the Medici Bank would issue him a bill of exchange. This bill would instruct the Medici branch in London to pay a certain amount of English pounds sterling to the wool supplier on a future date, say 3 months from now. The genius lay in the currency exchange rate and the time element. When the Florentine merchant bought the bill, the Medici banker in Florence would quote an exchange rate between florins and pounds. This rate was not a simple market rate. It was subtly adjusted to include the bank's profit, accounting for the time value of money, the risk involved, and the cost of the service. For example, if the normal exchange rate was 1 florin for 2 pounds, the Medici might offer a rate of 1 florin for 1.5 pounds for a bill payable in 3 months. The merchant would effectively pay more florins for fewer pounds, or more pounds would be received for fewer florins, depending on the direction of the exchange when the bill matured. That difference, disguised as an unfavorable exchange rate, was the bank's profit. It was not called interest, but it served the same purpose. It was a payment for the service of facilitating a cross-border transaction, and for the time value of money. The church might frown upon interest on a loan, but exchanging currencies was a legitimate commercial activity, especially when it involved two different places and a future date. This system was incredibly versatile. It allowed merchants to travel without carrying vast amounts of vulnerable physical cash. They could deposit money in one city and withdraw it in another, relying on the Medici's vast network of branches. It also allowed for credit. A merchant could receive a bill of exchange even if they did not have all the funds immediately, effectively taking out a short-term loan disguised as a deferred currency exchange. The Medici also used these bills to transfer funds for their own operations, moving money from profitable branches to those needing capital, or sending funds to Rome to finance the Pope's projects. The papacy itself became a major client of the Medici, ironically. The church collected tithes and revenues from all over Europe. These funds, often in various local currencies, needed to be transferred to Rome. The Medici bank stepped in as the perfect intermediary. They would collect the local currency from church officials in, say, France, and issue bills of exchange payable in Roman ducats at their Rome branch. This was a massive, consistent stream of business for the Medici, bringing them not only significant income through the disguised exchange rate profits, but also immense political leverage with the most powerful institution in Europe. Handling the Pope's finances gave the Medici privileged access and influence, making them indispensable. The widespread adoption of bills of exchange transformed European commerce. It made international trade faster, safer, and more efficient. It also allowed for the accumulation of capital and the financing of large ventures that would have been impossible under strict anti-usury laws. The Medici became masters of this intricate dance between finance and religious doctrine. They understood the nuances of commercial law and the power of clever structuring. By framing their profits as exchange fees rather than interest, they not only avoided the wrath of the church, but also positioned themselves as the leading financial facilitators of their time. Their ability to innovate within restrictive frameworks was a hallmark of their success, building an invisible web of financial power that stretched across the continent, all while keeping their hands clean, at least in the eyes of the church. Number 3, a web across Europe, the branch network model. Most businesses in the Renaissance were local. A craftsman had a shop, a merchant sold goods in his town. Even successful merchants might travel to trade fairs, but their operations were generally confined to a single city or region. The idea of a multinational corporation with offices stretching across a continent was largely unheard of, but this is exactly what the Medici Bank built. They were the pioneers of the international branch network, creating a financial web that spanned the major economic centers of Europe. This decentralized structure was a core pillar of their enduring success and massive reach. The Medici Bank was not just a single building in Florence. It was a sprawling conglomerate of interconnected, yet semi-independent branches. From their headquarters in Florence, the Medici established offices in crucial cities like London, Bruges, Geneva, Lyon, Rome, Venice, Milan, Pisa, and Avignon. Each of these branches was strategically located to tap into specific markets and serve particular clients. London was vital for the English wool trade, a crucial raw material for Florentine textiles. Bruges in Flanders was a hub for Northern European commerce, wool finishing, and luxury goods. Geneva and Lyon were crucial for trade routes connecting Italy with France and the Holy Roman Empire. Rome was the ultimate prize, the center of the Catholic Church, handling the vast financial flows of the papacy. Venice, a maritime power, connected them to the lucrative East. Each branch served multiple functions. They acted as deposit banks, taking in money from local merchants, nobles, and even other bankers. They facilitated international payments using the bills of exchange system, making it incredibly convenient for a merchant in Florence to pay a supplier in Bruges without physically transporting coins. They extended loans, often large sums, to local rulers, powerful families, and other merchants, carefully assessing the risks involved. They also served as intelligence outposts, gathering vital information about local market conditions, political developments, and trade opportunities, sending this data back to Florence. The establishment of each branch was a careful, deliberate process. The Medici would identify a promising location, often a city with significant trade activity or political importance. They would then send a trusted, capable manager from Florence, someone with a deep understanding of the Medici's business practices and values. This manager would set up the office, hire local staff, and begin building relationships with the local elite. The branch managers were essentially Medici lieutenants, empowered to make significant decisions, but always accountable to the headquarters in Florence. The existence of these branches provided immense advantages. For merchants, it meant unparalleled convenience and security. A Florentine merchant could deposit funds in Florence, receive a bill of exchange, and present it for payment at the Medici branch in London. This eliminated the dangers of highway robbery or shipwreck when transporting large amounts of gold or silver across Europe. For the Medici themselves, the network diversified their risk. If one region suffered an economic downturn or political instability, other branches in more stable areas could compensate. For example, if trade slowed in England, the booming papal business in Rome might keep the overall bank profitable. The sheer scale of this network allowed the Medici to dominate international finance. They could mobilize capital from across the continent, pooling resources from different branches to fund massive projects like royal wars or papal crusades. Their presence in so many key cities meant they were at the heart of nearly every major financial transaction in Europe. They facilitated the movement of goods, capital, and even people. They were a financial backbone for the burgeoning Renaissance economy, supporting trade, innovation, and political maneuvering on an unprecedented scale. The success of the branch network depended heavily on effective communication and strong internal controls. Regular letters and financial reports flowed between Florence and its branches, detailing transactions, market conditions, and local news. The double-entry bookkeeping system ensured that these reports were accurate and consistent, allowing the Medici leadership to maintain a clear overview of the entire enterprise. The branch managers, while having a degree of autonomy, operated under strict guidelines and were often partners in their respective branches, sharing in the profits and losses, which further incentivized their success. This intricate web of interconnected offices, each a miniature version of the Florentine headquarters, solidified the Medici's position as the leading financial power of their age, extending their influence far beyond the walls of Florence. Number 4. The art of the deal partnership agreements. Running a vast international banking empire like the Medici Bank presented enormous challenges, especially regarding risk and management. A single, monolithic company structure where all branches were merely departments of a central entity would concentrate all risk at the top. If a branch failed due to bad loans or political upheaval, its losses could theoretically bring down the entire bank. Also, finding talented and trustworthy managers willing to relocate to foreign cities and dedicate themselves entirely to the Medici's interests was a significant hurdle. The Medici cleverly addressed these issues with another financial innovation, the partnership agreement. The Medici Bank was not a single giant corporation. Instead, it was structured as a series of separate yet interconnected partnerships. The main bank in Florence, known as the Banco Privato, acted as the parent company and was solely owned by the Medici family. However, each of its foreign branches, such as those in London, Bruges, and Rome, was established as a distinct partnership. This meant that while the Medici family held the majority share in each branch, typically around 50% or more, the local branch manager and sometimes other key employees were also partners. This partnership model offered several critical advantages. First, it distributed risk. Each branch was legally a separate entity. If the branch in Bruges, for example, made a series of disastrous loans or faced a major political crisis that led to significant losses, those losses were primarily borne by that specific partnership. While the Florentine headquarters would certainly feel the impact due to its majority stake, the losses were not immediately and directly absorbed by the entire Medici Bank as a whole. This insulation mechanism helped prevent a domino effect, where the failure of one part could bring down the entire system. It provided a crucial layer of financial protection in an unpredictable world. Second, the partnership model was a powerful incentive for attracting and retaining top talent. Branch managers were not merely salaried employees. They were partners with a direct stake in the profits of their specific branch. This meant that if the London branch performed well, its manager, like Tommaso Portinari in Bruges, shared in the financial rewards. This motivated them to work harder, make shrewd decisions, and take calculated risks to maximize the branch's profitability. Their personal wealth and reputation were directly tied to the success of their branch, aligning their interests perfectly with those of the Medici family. It fostered a sense of ownership and dedication among the key players operating far from Florence. Partnership agreements were formal, legally binding documents meticulously drawn up and outlining the capital contributions of each partner, their share of the profits and losses, and the duration of the agreement. These partnerships were often set for a fixed term, typically 3 to 5 years. At the end of the term, the partnership would be dissolved, accounts settled, and profits distributed. A new agreement might then be drawn up, often with adjusted terms based on performance and market conditions. This regular renewal allowed the Medici to review performance, renegotiate terms, and make necessary changes, removing underperforming managers or adjusting the capital allocation if a branch's prospects had changed. An example of this was the Bruges branch under Tommaso Portinari. He was a partner, invested his own capital, and had a share of the profits. He was instrumental in establishing and growing the branch's operations in the Northern European market. However, his later decisions, particularly some massive loans to the Duke of Burgundy, ultimately led to significant losses for the Bruges branch partnership. Because of the partnership structure, these losses were largely contained within that specific entity, preventing an immediate collapse of the entire Medici network, even though the Florence headquarters, as the main partner, still suffered a substantial financial blow. The partnership structure also facilitated specialization. Each branch manager could tailor their operations to the specific economic conditions and client needs of their region. The Rome branch focused heavily on papal finance, while the London branch specialized in loans to the English crown and the wool trade. This localized expertise, combined with the shared financial interest, made each branch highly efficient and responsive to its immediate market. The Medici family, by masterminding this intricate web of interconnected partnerships, created a robust and flexible organizational structure that allowed them to manage immense wealth, distribute risk, and motivate their key personnel across an entire continent. It was a sophisticated corporate strategy centuries ahead of its time, demonstrating a deep understanding of human motivation and financial architecture. Number 5, information is gold, the Medici intelligence network. In the 15th century, communication was slow and unreliable. News traveled by horse or ship, often taking weeks or even months to reach its destination. There were no newspapers, no instant messages, no 24-hour news cycles. Yet, for a bank operating across a continent, having up-to-the-minute information was not just an advantage, it was absolutely critical. Knowing about political instability, wars, crop failures, changes in trade routes, or currency fluctuations could mean the difference between immense profit and catastrophic loss. The Medici family understood this profoundly, and they built an intelligence network that rivaled and often surpassed that of European monarchs and the papacy itself. Every Medici branch manager, every traveling merchant associated with the bank, every agent or diplomat paid by the family was, in essence, an information gatherer. Their primary duty might have been financial, but a crucial secondary role was to collect and transmit intelligence back to the main headquarters in Florence. These individuals were strategically placed in major economic and political centers across Europe. They were privy to the whispers in royal courts, the gossip in bustling markets, and the official dispatches from diplomatic channels. Letters were the lifeblood of this network. Medici agents and managers regularly wrote detailed letters back to Florence, often addressed to Cosimo de' Medici or his successors Piero and Lorenzo. These were not just dry financial reports, they contained rich, detailed accounts of local affairs. A manager in London might report on the king's financial struggles and his likelihood of defaulting on a loan, or perhaps news of a new alliance forming that could impact trade. A correspondent in Bruges might detail the price of wool and the demand for Florentine textiles. An agent in Rome would send intelligence about papal elections, the health of the current pope, or shifts in the church's financial needs. These letters were often written in code or used euphemisms to protect sensitive information from prying eyes. They contained political predictions, economic forecasts, and even personal details about influential figures. The Medici family meticulously processed this flood of information. They had clerks dedicated to reading, organizing, and summarizing these dispatches. They cross-referenced reports from different sources to verify accuracy. This allowed them to build a comprehensive real-time picture of the European landscape. Knowing that a war was brewing in France, for example, would allow the Medici to adjust their lending practices in that region, perhaps calling in loans or avoiding new ones. Information about a poor harvest in Sicily could prompt them to invest in grain ahead of anticipated price increases. Early warnings about a shift in papal policy could give them a lead on securing lucrative contracts or avoiding unfavorable ones. Their intelligence network allowed them to anticipate market movements and political events, giving them an unparalleled advantage over their rivals. They could make highly informed decisions about where to lend, where to invest, and where to pull back. The family even cultivated their own network of spies and informants. Sometimes these were individuals officially involved in diplomacy or trade who were also secretly sending reports to the Medici. Other times, they were paid informants embedded in rival banks or foreign courts. Their diplomatic ties, particularly with the papacy, also provided a legitimate channel for gathering high-level political information. The Medici were essentially operating a sophisticated private news agency with its own sources, analysis, and rapid dissemination system, all focused on serving their financial and political interests. This continuous flow of actionable intelligence was a silent, powerful weapon in the Medici's arsenal. It informed their financial strategies, mitigated their risks, and opened doors to new opportunities. While others operated in relative darkness, making decisions based on outdated information or rumors, the Medici moved with a clear vision, guided by a constant stream of verified intelligence. This relentless pursuit of information and their mastery of its analysis and application solidified their position as not just bankers, but as masters of the European power game, their decisions always one step ahead. Number 6, beyond the vault, diversification into trade and industry. When people hear Medici Bank, they often think only of lending money. But the Medici family was far more than just bankers. They understood that putting all their eggs in one basket, even a very large and profitable banking basket, was risky. They diversified their investments, spreading their wealth across a variety of industries and ventures. This strategy, common in modern finance, was a revolutionary concept in the Renaissance, allowing them to weather economic downturns and multiply their profits far beyond what mere lending could achieve. Their money was not just sitting in vaults, it was actively making more money in the real economy. One of the most significant areas of Medici investment was the textile industry, particularly wool and silk. And Florence was a renowned center for high-quality textiles, and the Medici owned and invested in multiple stages of this lucrative trade. They had vast sheep farms, ensuring a consistent supply of raw wool. They invested in spinning and weaving workshops where raw wool was transformed into cloth. They also had interests in dyeing operations, producing the vibrant colors that made Florentine textiles so prized across Europe. This vertical integration, controlling the production process from raw material to finished product, gave them immense control over quality, supply, and pricing. They were not just financing textile merchants, they were textile manufacturers and traders. Another crucial industrial investment was in alum. Alum was not a glamorous product. but it was essential for the textile industry. It acted as a mordant, a substance that fixed dyes to fabric, making the colors permanent. Before the mid-15th century, most alum came from Turkey, controlled by the Ottoman Empire, making it expensive and unreliable. Then, in the 1460s, vast deposits of alum were discovered in Tolfa, near Civitavecchia, in the Papal States. The Medici quickly recognized the immense potential. They secured the mining rights from Pope Pius II, effectively gaining a monopoly on the European supply of alum. This was an incredibly strategic move. By controlling this vital resource, they could dictate prices to the entire European textile industry, including their own competitors. The profits from the alum monopoly were immense, providing a steady and massive stream of income that diversified their revenue far beyond traditional banking activities. Beyond textiles and alum, the Medici also invested in other areas. They owned lucrative merchant ships facilitating the transport of their own goods and those of others across the Mediterranean and Atlantic. They engaged in international commodity trading, dealing in spices, grains, and other valuable goods. They bought land and agricultural estates, generating rental income and food supplies. They even had interests in mining operations beyond alum, seeking out other valuable minerals. This extensive diversification provided a crucial buffer against economic shocks. If the banking sector faced a crisis, such as a major loan default by a king, the profits from their textile mills or the alum monopoly could help absorb the losses. Conversely, if demand for textiles fell, their banking operations might be thriving. This strategy ensured a more stable and resilient financial empire. It also allowed them to leverage their banking knowledge and network. Their branches facilitated trade and payments for their own industrial ventures. Their intelligence network provided market insights for their commodity trading. Their wealth from banking could be easily deployed into new industrial opportunities. The Medici were not just financiers facilitating the trade of others. They were active participants in the real economy, operating as industrialists, merchants, and landowners. This holistic approach to wealth generation, moving far beyond the traditional confines of banking, was a key differentiator for the Medici. It demonstrated a sophisticated understanding of interconnected markets and risk management, turning their financial capital into tangible assets and continuous revenue streams. This shrewd strategy made their fortune not just deep, but wide, creating a robust and multifaceted empire that was less vulnerable to the unpredictable whims of any single market or political event. Number 7. Investing in immortality, patronage, and public image. The Medici family possessed staggering wealth, but they understood that money alone, especially in a republic like Florence, was not enough to secure enduring power. They knew that true influence, lasting legacy, and political stability required more than just financial acumen. It required public goodwill, cultural prestige, and a visible commitment to the city they dominated. Their solution was to become the greatest patrons of art, architecture, and scholarship the world had ever seen, transforming Florence into the cradle of the Renaissance. This was not mere generosity. It was a calculated investment in their public image and a sophisticated tool for consolidating their power. The Medici poured immense sums of money into commissioning magnificent works of art and architecture. They funded artists like Michelangelo, Leonardo da Vinci, Botticelli, and Brunelleschi. They did not just buy existing art, they cultivated artistic talent, supporting young artists from their earliest training. Cosimo de' Medici, for instance, famously supported Brunelleschi in completing the dome of the Florence Cathedral, an engineering marvel that had baffled architects for generations. This visible patronage associated the Medici name with beauty, innovation, and civic pride. The dome stood as a testament not just to Brunelleschi's genius, but also to Cosimo's vision and wealth. Their architectural projects were equally impressive. The Palazzo Medici, their family home, was a monumental structure that redefined urban palaces, combining grandeur with understated elegance. It projected power and prestige without explicitly mimicking a royal residence. They also funded the rebuilding and renovation of numerous churches, including the Basilica of San Lorenzo and the Dominican convent of San Marco. These were not just places of worship, they were also public spaces, adorned with art that bore subtle or direct references to the Medici family. Their coat of arms, featuring 6 balls, became ubiquitous throughout the city, subtly reminding everyone of their presence and influence. Beyond art and buildings, the Medici invested heavily in scholarship and learning. They supported the Platonic Academy, a group of humanist scholars who revived the study of ancient Greek philosophy, particularly the works of Plato. They accumulated vast libraries filled with rare manuscripts and newly translated texts, making these resources available to scholars and the public. This patronage of intellect cemented their reputation as enlightened rulers, champions of knowledge, and leaders of a cultural revival. They funded scientific inquiry, collected ancient artifacts, and invited renowned thinkers to their court, fostering an atmosphere of intellectual dynamism. The Medici also used their wealth to fund elaborate public festivals, celebrations, and spectacles. These events, often featuring allegorical floats, plays, and musical performances, entertained the Florentine populace and showcased the family's generosity and cultural sophistication. Such events served as a powerful form of propaganda, dazzling the citizens and diverting attention from any underlying political tensions. They made the Medici seem benevolent rulers, guardians of Florentine identity and prosperity, rather than mere bankers who held the city in their financial grip. This strategic philanthropy served multiple purposes. It projected an image of piety and civic responsibility, counteracting any lingering criticisms of their wealth accumulation, particularly their clever navigation of usury laws. It associated the Medici name with the Golden Age of Florence, inextricably linking their family to the city's greatest achievements. This cultural legacy became a powerful source of legitimacy for their informal rule. The beautiful city, teeming with masterpieces, became a constant reminder of the Medici's gifts to the Florentines. Their investments in art and scholarship were not just expenses, they were shrewd expenditures that yielded immense returns in terms of public admiration, political stability, and an enduring legacy that cemented their place in history, securing a form of immortality that no mere bank balance could ever achieve. The art and architecture still stand today, speaking silently of their immense wealth and power.